Take Jordan. He thought he outsmarted the system when he moved his cash into a high-yield savings account paying 4.5%. He did his homework. He fully understood that standard bank accounts were basically a scam, while others settled for 0.45%. He earned 10 times that. He thought he solved personal finance. He really did not. His bank was still earning way more off his own deposit than he was. And whatever that online bank was doing to generate yield, he could have done the exact same thing himself and kept every single penny. But this is where it hurts. His coworker Maya still kept $20,000 parked in a basic, everyday savings account. Over 1 year, her bank paid her $76 in interest. Meanwhile, they took her 20 grand and flipped it to make over $1,200. She took the $76. They kept the massive difference, and she actually felt grateful. Maya never realized she was actively losing wealth. Jordan believed he outplayed them. Honestly, both were losing, just at different speeds. I ran the passive income numbers on both scenarios. Let's look at the reality banks hide from us. Maya followed every rule. She responsibly saved up 6 solid months of living expenses. She stashed it away at a major national bank. Every month, she checked her banking app and noticed a tiny little interest deposit. It was never much, a couple bucks here and there, but doing it made her feel like a responsible adult. It felt entirely secure. Her account yielded 0.38% APY. That is the actual national average right now. On $20,000, that is $76 a year. About $6 monthly. Not even enough for lunch. Now, Maya likely never stopped to wonder what the bank actually did with her 20 grand while it supposedly sat there. She probably pictured her cash resting safely inside a steel vault, just waiting for her. It absolutely was not. The second she deposited that cash, they put it to work for themselves. Not her. Stick with me. Here is exactly what they did with it. First off, they immediately lent her cash out to other people. That is the fundamental business model of every single American bank. They hold your deposit, pay out pennies in interest, and then loan your exact money to somebody else at a significantly steeper rate. The huge gap between what they toss you and what they collect is known as the net interest margin. Right now, the average net margin for American banks sits at 3.39%. That is the absolute highest since 2019. Let us look at the raw numbers. Her bank gave her 0.38%. They pulled in 3.39% lending her money. On 20 grand, that is a spread of about $602 yearly. The bank pockets, Maya got $76. The bank took $602 from her deposit, but that is just the average. Let us check out the truly massive profit margins credit cards. In early 2026, the average annual percentage rate hit 21%. Her bank grabs her funds, pays her 0.38%, then instantly loans that identical cash to credit card users at 21%. That is a profit spread of 20 full percentage points. If the bank pushed even a tiny sliver of Maya's 20 grand toward credit lending, the massive return on that tiny chunk instantly crushes whatever interest they paid her for the whole year. Look at auto loans. Right now, financing a brand new car averages out to around 7.5%. Mortgages run 6.8%. Personal loans hit 12%. Every single one of these debt products is powered by cash, like Maya's deposit. And each one generates massive multiples of what she actually takes home. Then comes the Treasury trade. Honestly, this is the exact part that should make your jaw completely drop. They take a chunk of her money and buy short-term government debt. Currently, 3-month Treasury bills yield roughly 3.6%. The financial institution buys those ultra-safe bonds using her funds, collects 3.6%, while handing Maya just 0.38. That creates a huge 3.22% spread. On a safe asset she could just buy herself. The bank acts as a middleman to the government and skims 3% for the privilege, and then we have the hidden banking fees. US banks snatched $12.1 billion in overdrafts, ATM charges, and endless maintenance fees in just one single calendar year. JP Morgan Chase alone raked in over $1 billion purely from overdraft penalties in 2024. Wells Fargo grabbed nearly the same amount. They charge these massive fees to the exact same savers whose deposits fund their lucrative loans. Her 20 grand just blindly fuels that entire banking machine. We have not even mentioned swipe fees yet. Every single time she uses her debit card, her bank happily takes a cut from the store, or the silent profit they make holding on to pending transactions, earning interest off your cash for days before the payment officially clears the system. We also cannot ignore the personal spending data they legally bundle up and quietly sell off to their corporate marketing partners. Each of these creates another wild profit stream built directly on her cash. When you and I add it all up, the truth hits hard. Her bank never just held her money. They rented her cash. The bank paid Maya $76 a year to use her 20 grand however they wanted. And she actually thought she was earning interest. Now, you and I need to look at Jordan. He's the guy sitting there watching this, thinking, I already knew that. That is exactly why I moved my money to a high-yield savings account. And honestly, Jordan is right. He is miles ahead of Maya. His account pays 4.5%, while Maya earns just 0.38 on 20 grand. Jordan makes roughly $900 yearly compared to Maya's 76. He did his homework. He switched. He makes 10 times more than the average saver. So what is the catch? First off, that 4.5% might be totally fake. Many high-yield bank accounts heavily promote earning up to a certain rate. Those two words do a lot of heavy lifting. Some banks use tiered structures where the top rate only hits your first $500 or $1,000. After that, the rate drops fast. Some tease a high rate for 90 days, then silently slash it. Jordan just saw the 4.5% headline. His real rate might be way worse. The second huge issue is the taxes. Any interest from a bank savings account, basic or high yield, gets taxed exactly like your regular day job income. You are paying federal taxes plus state and local taxes. Between a 22% federal bracket and a 5% state tax, he loses over a quarter of his gains. His $900 drops to $657. But here is the third and biggest issue. What is that high yield account actually doing with his hard-earned money? How exactly does the bank afford to pay Jordan 4.5%? They do the exact same thing Maya's bank does. They lend it out. They buy government treasuries. It is the exact same profit machine. The only real difference is a high-yield account gives a slightly larger slice to you. But it is only a slice. The bank stays the middleman, and they still take their cut. But here is the critical question Jordan missed. If they use my cash to buy treasury bills and earn 3.6%, why don't I just buy them myself? Professor Wealth ran the numbers. Same 20 grand. Same 12 months. 3 different setups. Scenario 1. Maya's account at 0.38%. Gross interest is $76. After federal and state taxes, she keeps about $55. That is her full year reward for responsible saving. Scenario 2. Jordan's high yield account at 4.5%. He earns $900 gross. After combined taxes take 27%, he keeps roughly $657, a massive win over Maya. But here is the catch. He pays federal and state taxes on every single dollar of that interest. Scenario 3. A short-term treasury fund, like SGOV, as of April 2026, SGOV yields 3.95%, with a 30-day SEC rate of 3.55. On 20 grand, that brings in roughly $790 gross over a year, or $710 at the current rate. Now this is where it gets good. Let's look at this closely. U.S. Treasury interest is exempt from state and local taxes. It is federal law. So Jordan gets double taxed on his $900. The SGOV investor only pays federal tax on their $790. After taxes, they keep around $616. And they completely dodge any state or local taxes. You might look at the math and say, hold on, Jordan's bank account still wins by a few raw dollars. In this exact snapshot, Sue, 4.5 beats 3.95. But that comparison misses something huge. Jordan's 4.5% is just a marketing rate. They can change it whenever. Next month, the bank could drop it to 3.5 and just email him. SGOV tracks real Treasury rates set by government auctions. It is fully transparent. It is entirely market-driven. Zero bait and switch. Meanwhile, Jordan still pays state taxes. SGOV does not believe any. In brutal tax states like California or New York, that exemption alone bridges the whole gap. Plus, Jordan's setup keeps the bank acting as a middleman. Buying treasuries cuts them out completely. You lend directly to the government through treasury bills, keeping the full return minus a tiny 0.09% fee. Look, and the point is not that one route always beats the other in every single situation. The issue is that Jordan never even knew this existed. He thought his high-yield account was the ultimate finish line. It isn't. It's a better seat in the same machine. So, here's what Professor Wealth recommends for you. I promise it is simpler than you think. First, I'll keep that checking account open. You still need it for everyday expenses like rent, bills, and groceries. I am not telling you to change how you spend. It is only about where your lazy money lives. Next, find that idle cash. I mean your emergency fund, your basic savings, or cash set aside for a house down payment or any other big future buy. This cash just sits in a savings account earning pennies, while your bank quietly makes 10 to 50 times more off your hard work. So, let's look at your options to move that cash. Option 1 is a Treasury bill ETF like SGOV. Buy it through whichever brokerage you already use, like Robinhood, Schwab, Fidelity, or Webull. You just buy it like a stock. The fund takes your cash and buys short-term US Treasury bills that mature in 3 months or less. You get a dividend every month. That is the interest. It yields around 3.55 to 3.95%, depending on your measure. When you need that cash back, just sell during market hours. The share price stays right around $100. It is designed for that. The fee is 0.09% annually. On $20,000, that is $18 a year. Plus, your payouts are exempt from state and local taxes. Option 2 is treasurydirect.gov. This is the official US government website where you buy treasury bills directly. Absolutely no middleman, no brokerage, no ETF, and no fees. You just set up an account, link your bank, and buy T-bills at auction. They mature, and you get your cash back plus interest. The only downside is it is less liquid than an ETF. You are locking in a maturity date of 4 to 52 weeks. But if you do not need instant access, this is the best way to cut out the middleman. Option 3 is a money market fund. These funds are offered by major brokerages like Fidelity, Schwab, and Vanguard. They buy short-term government securities and other high-quality debt. They offer daily liquidity. You can pull your money out anytime you want. The yields easily compete with high-yield savings accounts right now. Plus, if you pick a Treasury-only money market fund, you get that exact same state tax exemption as SGOV. Here is the objection you and I always hear. My savings account has FDIC insurance. That is true. It covers up to $250,000 per depositor, per bank. If the bank fails, the federal government guarantees your cash. That is real protection. But think about the comparison. Treasury bills are debt issued by the exact same US federal government that backs that FDIC. When you buy a Treasury bill, you are lending your money directly to the government. The default risk is basically zero, simply because the government can print money to pay its own debts. You are absolutely not sacrificing safety by moving from a savings account over to Treasuries. You are shifting from a government guarantee on a bank to lending directly to that same government. Honestly, it is even more direct. The second big objection I hear is needing instant access. Fair point. That is exactly why you keep your checking account funded for daily needs. But for an emergency fund in SGOV, yes, There is a 1 to 2 day settlement window. When you sell, but be honest, when did you last need $20,000 in cash? Within 60 seconds. In any actual emergency, waiting 1 to 2 business days is usually perfectly fine, and the extra yield you earn waiting for an emergency to hit is hundreds of dollars annually. Take Maya. She was incredibly responsible. She saved her cash. She kept it safely in a bank. She regularly checked her balance. She played perfectly by the rules she was taught. Then there was Jordan. He was informed, so he chose a high-yield savings account. He earned 10 times what Maya did. Jordan really thought he had finally cracked the code. But neither of them ever asked the real question, what is the bank actually doing with my cash? And could I just do it myself? The answer is absolutely yes. Your bank takes your deposit, buys Treasuries, lends it at 7, 12, or 21%, and pays you a fraction of a percent. The smartest financial move is not hunting for a better savings account. It is asking why you even need one. If you and I uncovered something new about your money today, make sure to subscribe to Wealth Logic and hit that notification bell. I break down the hidden math behind the big financial decisions you face every single day. And the next video is one you really do not want to miss.